If you want to build $1 million portfolio, you don't need secret stocks, you don't need perfect timing, and you definitely don't need to gamble when it comes to investing. You need structure. And in today's video, I want to break down and walk through exactly how you can build $1 million portfolio using real ETFs, the same type of portfolio that I build. And looking at the funds in here, it is what long-term investors actually use. No hype, no speculation, just a plan. So let's go ahead and break this down. So before we get into this, you have to understand the math. This is the $1 million question. It sounds massive. Mathematically, it is very predictable and it is based on contributions. If you invest $1,000 a month at an 8% return, you'll reach $1 million in 26 to 27 years, depending on exactly the return. If you're investing $2,000 a month, 8% return, to reach that $1 million, you're looking at 20 years. So cutting about 7 to 8 years off of that time frame. If you're investing $4,000 a month, you're roughly there in 14 to 15 years. That is based on an 8% return. What we know right now, traditionally in the stock market, we're looking at a 10, a 12, a 14, depending on what ETFs you're invested in over the last 10 years. We have seen some really, really good returns. And of course, this run up getting to that $1 million portfolio is going to come much quicker if the percentages are a lot higher. It isn't about magic. It isn't about really anything in general. It is about compounding. When you look at this video, it isn't about chasing your 20% returns. It's about building a system that can average about 8 to 10%. And historically, it is very achievable with the diversified portfolio of ETFs. Now, when we start thinking about the core of the portfolio, this is something that we've touched on before. This is where boring wins. And I'm going to talk about really 3 specific ETFs in here that are focused on the total stock market. So we are looking at the VTI, which is the Vanguard Total Stock Market, or the ITOT, or the SCHB, all variations that do the exact same thing. You're looking at investing in large cap and mid cap and small cap. It is going to have everything. It is massive diversification. Now, when we start thinking about a core, in this one, of course, going out to Gary, one of my faithful subscribers from AFK Arena, but talking about a core you could possibly do, and this was his recommendation, doing something like the SPMO, so doing that S&P 500 momentum fund as a core, putting it at a higher percentage because it has outperformed not only the VTI, but the VOO as well for an extended amount of time. So if you're willing to take the risk, and again, chasing those higher returns that are going to outperform the S&P 500, that SPMO or that momentum fund might really make a big difference. Now, when we start breaking it down, instead of that total return or the total market, that includes the mid cap and the small cap. You could even look at the VOO, the SPY, or the IVV. These are concentrated in these mega tech companies in the S&P 500. Historically strong. We are seeing a return of around 12%. Very low cost, very high liquidity. These are what are, again, people really see as the core when it comes to an investment portfolio. Then we want to take a minute and talk about international exposure. We are talking at the VXUS, which is the Vanguard Total International, the IVUS, and the SCHF, which is developing market. This is pretty interesting because as we're seeing it sitting in 2026, the international markets have been outperforming the US markets. Don't know if it's going to continue, don't know how long it's going to continue, but when you start thinking of a core of a portfolio, again, you could put in a couple ETFs, and a sample of this would be 70%, let's say in a core like the VTI, 20% in the international, that is the VXUS, and that is really making up that 70% of the core. Those are going to be your holdings in the entirety. Like I said, you could switch it up. You could do like an SPMO for a core with a little bit of international, and they actually do have an international fund. That is the momentum fund for international, really focusing and kind of cherry picking companies, and it rebalances on a regular basis. But it, again, kind of cherry picks the best companies or the companies that they're looking at having the most momentum when it comes to the global markets. Low cost, global diversification in a portfolio, tax efficiency, that is going to be the engine. Now we start breaking into stability. As it grows, volatility matters more and more as the portfolio gets larger in size, as we're moving towards that $1 million portfolio. This is where some of the examples like the BND, the total bond market, the AGG, or looking even for something like the SCHD, that is going to provide value. That is going to provide essentially a very, very stable. We're not chasing returns. We're not looking for the 10, 12, 14, 18%. This is what is going to smooth out volatility in the portfolio. And this is going to be roughly 15 to 20% of the portfolio. And this is going to vary depending on age. If you're much younger, 20s and 30s, chances are you want a little bit more volatility, even if the market does go up or down. You have a lot longer to recover if there is a big drop off, and of course, with a big drop off, gives you a massive opportunity to put a ton of money in there. But of course, when it comes to the $1 million portfolio, the wild swings, and there are going to be much, much bigger swings when you look at the dollars, when you look at the percentages. This is where you have to have the emotional fortitude to not move money, to not pull it out, to make adjustments in this portfolio, because it is going to be massive. So when we think about this, and when we start thinking about stability or really value in a portfolio, if you have a $1 million portfolio and all of a sudden something drops, 5, 10, 15%, you're talking, 50,000 to $150,000 drop in a portfolio at 15% when you're looking at a $1 million portfolio. So again, you have to get a hold of it. And really, when it comes to the emotional investing, it has to go completely out the window as you continue to grow bigger portfolios and much larger wealth. Now, step 4, what we're looking at is targeting growth. Now, this is going to be your not really gamble, but it is going to be more of a satellite or a tilt that we're looking in here. And looking at a growth tilt, we are looking at like the QQQM. You could look at the VUG. You could even go for specific sectors. If you're looking at the SMH, the Big Van X Semiconductor Fund, you could do healthcare with the XLV. You could also look at energy with the XLE. You could also focus a little bit more, if you wanted to, into a little bit more of a dividend like a VIG, the QQQI, the SCHD. There are a couple of variations in there where when you start looking at possibly a little bit more growth or more of a dividend focus, more of an income focused versus a growth focus, there are going to be some very important sectors in here. But the key is here, you want to keep the sectors capped at a certain percentage. You don't want something like the QQQ to actually run up 3, 5, 10 years, and then your portfolio be absolutely disproportionate when it comes to the investment structure. We are looking at 10 to 15% in here. The wealth in this portfolio is built in its entirety by the core. Adding this layer of tilt is not really the risk of concentration, and just doing a little bit, again, that 10 to 15%. And think about it this way. When you think of a core portfolio, so let's say, for instance, you're putting 50% into something like the VOO, and we're just going to use that as a basis. If you have 10 or 15% in something like the QQM, and that 10 to 15% is outperforming the VOO on a regular basis, your portfolio is going to be, and honestly, the return is going to be much higher than we're seeing on the market itself, because you are actually beating out the market with the QQQM, or you're beating out the market with the SPMO. And even looking at a growth tilt, a lot of people do use the SPMO like we talked about earlier, really looking at the momentum fund for a lot more concentration, but also being to outperform the S&P 500. Now, when it comes to the portfolio overall, it's really not the huge focus. Again, thinking of the 15, 20, 25, 30% returns that we're seeing here, guys, that comes in very high risk, very high speculation. When we start looking at something like Bitcoin that's averaging, I believe, around 50% a year return, it is kind of crazy, because you can take that much exposure, you can take that much risk. For a majority of investors, you're not going to see, and if the market goes south, you're not going to have the ability to see another 20, 30, or 40 years of compounding, which really do grow wealth as we know it today. And of course, none of this works, and the allocation to $1 million getting to this portfolio will never work without contributions. We talk about automating it, whether you're doing monthly, you're doing bi-weekly, you're doing weekly, you're doing your income cycles, increasing it annually. If you're leaving it and really income goes up, let's say you get a 5% raise, put 2% into the investing account, add another 3% into the investment account. Lifestyle inflation is the silent killer when it comes to these portfolios in their entirety. Now, one thing we want to look at, and one thing we want to remember, once a year, check the allocations. If they are too far out of tilt, you want to go in there, and if equities ran hot, if you got the QQQM that's absolutely crushing it, go ahead and rebalance on an annual basis. Don't want to rebalance really outside of an annual basis. Maybe even set, time to review your portfolio. A lot of people go in here and they go through and just really rebalance on a regular basis. Buying and selling is kind of crazy. When you're looking at it, it is not a strategy that I recommend. For a lot of people, they don't want to rebalance. They want to let just the ETFs that are running to absolutely run. But again, rebalancing does make a big difference, because when it comes to derailing investment portfolios like this, it's not the ETFs, it is the behaviors that we see absolutely just crush the portfolio. Panic selling in downturn, chasing performance, looking for a couple more percentages, strategy changes, tax inefficiency, and of course, stopping contributions will absolutely crush the portfolio in the entirety. So when we look at a portfolio like this, $1 million portfolio isn't built in one single year. It is built in 20, 30, 40 years to have $1 million in that retirement account. And these investors that are building these are not brilliant at all. They are very consistent with what they do. They own broad market index funds, controlling the cost and keeping them low, rebalance on an annual basis, contribute like I do every single week, stay calm, don't pay attention to any of the news in the entirety, because of course, when you start breaking it down, the world is ending at least twice a week, probably even 3 times on a weekend. It's kind of crazy to see, because you don't need complexity when it comes to investing. You need structure, and structure compounds over time. So, all right, guys, so that's going to do it for today's video. Definitely give it a like, subscribe to the channel if you haven't yet, and I'll catch you in the next video.